Welcome to Beyond the Box. I'm your host, Nicole Allam. This is our final episode this season, and we're delighted to have two fantastic guests from the World Bank Group and the International Finance Corporation with us. Today, we're diving into the World Bank Group's Commodity Markets Outlook, which looks at major commodity groups like energy, metals, and agriculture. The report offers forecasts and insights on how commodity price movements affect global trade, growth, and inflation. The latest edition, released in October, points to continued price declines across most major commodities, a trend with big implications for trade flows, shipping demand, and supply chains worldwide. And I'm very pleased to introduce our guest to discuss what the findings might mean for global supply chains and logistics strategies as we head into 2026. First, John Baffes, senior economist at the World Bank, who leads the commodity price forecasting process. We're also joined by Farzin Mirmotahari, Senior Operations Officer for Supply Chain Finance at the International Finance Corporation, or the IFC. Welcome, John and Farzin.
Thank you, Nicole, very much. I'm so happy to join to the program and discuss our latest findings from the Commodity Outlook.
Thank you. Very nice to be with you today.
Thank you both. So we'll dive right in. The Commodity Markets Outlook projects that another 7% decline in global commodity prices in 2026, marking the fourth consecutive year of decreases. Energy markets remain oversupplied, metals are steady, and agricultural prices are largely stable. At the same time, the transition toward renewable energy and critical minerals is reshaping which commodities are in demand and where they're moving. John, what's driving this broad downturn across energy, metals, and agriculture? And how do the energy transition and critical minerals fit into that picture?
Thanks, Nicole, for the question. As you pointed out, we expect a broad sort of downturn in most commodity prices. Not all. There are a few exceptions, which we'll discuss later. But let me start with energy. We expect the energy price index to decline about 12% this year, and we also expect another decline next year. So in addition to the past 3 years of declines, we have 2 consecutive years of expectations about the upcoming outlook in energy markets. Now, let me start with oil. Oil prices has been averaging around $65 per barrel the past quarter, and that's quite low compared to what we experienced last year. And what we see in the oil market is that we see what we call an oil glut, so to speak, plentiful of supplies. Let me start with the major suppliers. We start with the United States, which still supplies a lot of oil that comes mostly out of its shale oil industry. Then we have Russia, which, despite all the sanctions and the restrictions and the difficulties that they are facing exporting oil, still a lot of oil comes out of Russia. And most importantly, we have OPEC Plus, which is the group that kind of regulates, in a sense, oil supplies in the global scene. And the OPEC had introduced cuts throughout 2023 and 2024, but later in 2025, they decided to remove the cuts. So we see plenty of oil coming out of OPEC Plus as well. So we have 3 sources of supply created this oil glut. And then we have issues on the demand side. The global outlook, while it's comfortable, it's still a bit weaker than expected. But a more important component of the oil demand is China. China has taken extensive steps to do its transportation industry. A lot of passenger cars in China, probably as much as 50%, are electric cars, so they do not consume gasoline. But what's interesting is that also there are downward pressures from the trucking industry. Most of the trucks that are sold in China right now, they are not using diesel. Instead, they are using natural gas. So, to summarize, a glut in the supply side among the 3 major producers and the weakening demand globally, especially in China, have created this surplus condition in the oil market for this year. Now, moving to other markets, let me talk a bit about agriculture. Agricultural markets are in a little under sort of stress in the sense that we have plenty of supplies there. We expect that supplies will be higher than what is the the global long-term average. So that also has kind of pushed grain prices downwards. Now, in metals, I would say there the market is more balanced. When we put all metals together, all base metals together, what we see is that on average, the market is broadly balanced, demand supply, and that's why you expect a kind of stability in the stable prices in that portion of the commodity markets. But we have a few exceptions. We all know what happened to gold. It's above $4,000 per troy ounce. And then, before I conclude the overall picture, we have the tropical commodities such as coffee and cocoa, which the price of which have increased considerably. And there it appears that we have climate issue concerns because a lot of tree crops, the prices have increased quite a bit the last 3 to 4 years. And it appears that we may have climate issues there that kind of defies the trend, that goes against what we have seen in most commodity markets is fertilizers. Fertilizers prices are under some upward pressure recently, and that reflects some trade restrictions by China, which exports much less fertilizers than what they used to the year prior. So to summarize, most prices are under downward pressure, but we have exceptions: tropical commodities, fertilizers, and precious metals.
Fantastic. Thank you so much for that overview. And Farzin, we'll get to you in just a moment. But I do want to ask, perhaps to start with you, John, and then over to you, Farzin. Can you explain how falling commodity prices can challenge exporters and manufacturers? And then for Farzin, I'd love to hear your stance on how your organization manages that as well.
The commodity markets have two sides. Low prices are good for consumers, bad for producers. Conversely, high prices are good for producers, but for consumers also.
And Farzin, from the IFC's perspective, how do you help manage this issue?
Thanks, Nicole. So at the IFC, essentially, we're providing liquidity into global supply chains. The program is structured such that we can leverage the balance sheet of global buyers, investment-grade companies, without adding any debt to the buyers to finance these exporters. We're quite active in the commodity space, especially in agribusiness. We finance exporters of cocoa, coffee, sugar, many other products. But not just limited to that, we also finance exporters of textiles, machinery. So it's multi-sector. And essentially what we find is when commodity prices are high, there's a much larger need for financing. Obviously, the exporters have higher inventory, and so they're needing to finance that. Conversely, and so we provide more liquidity into the market in that space. And when commodity prices are low, especially smaller suppliers, they will have harder time getting financing. Their margins are going to be really pressured. And so we find they actually use more of the financing facilities as a share of their sales. So in that way, essentially, we're mitigating the effects of high commodity prices as well as low prices.
Thank you. And John, even with sluggish global growth, emerging markets remain really central to commodity demand and manufacturing. And I'm wondering if you can share insights into which regions are showing the most resilience and how policy is reshaping their trade and supply chain patterns.
When we do our global growth analysis and forecast in the World Bank, we always separate the global growth into two major components: advanced economies and the rest of the economies, which we call emerging market and developing economies. So this is the group that kind of is affecting commodity markets and is affected a lot by commodity markets. And in fact, we expect growth to be much higher in both this group of countries compared to advanced economies. So, having said that, in terms of regional composition, I would say that Latin America, from the agricultural and grain perspective, and now that we are facing some trade issues from North America and other regions of the world, other parts of the world, I think that this is the region that is likely to benefit the most. And that's clearly the case, as we may have heard, it's the soybean kind of exports, that because China restricted soybean imports rather from the United States, we see that Brazil sort of fills the gap, so to speak. Now, when it comes to energy, as I said earlier, low energy prices is kind of not good news or bad news for energy exporters in the Middle East and North Africa. But what we see there is that at least when we look at the natural gas side, I would say North America, in particular the United States, is a big winner because we see a shift now in Europe and elsewhere in the world from pipe connections to LNG, then liquefied natural gas. And then when it comes to metals, we see some signs in Africa. There are a lot of African countries that are exporting either base metals or even critical materials. Just to summarize, what I would say, Latin America on the grain side, North America on the energy side are the major beneficiaries. And on the import side, probably Sub-Saharan Africa is the beneficiary. And let me also know that Sub-Saharan Africa, a lot of countries export tropical commodities. At the current high prices of coffee and cocoa, they're benefiting them quite a bit. So,
thank you so much. And Farzin, I'd like to turn to you. You know, the IFC has been investing in regional manufacturing clusters and decarbonization initiatives. I'm hoping that you can share some examples of how these investments are helping emerging markets build stronger, more sustainable supply chains, and what you think this could mean for future trade.
Yes, thank you.
As we partner with global buyers that are purchasing from thousands and thousands of suppliers in emerging markets, many of these buyers have standards and have targets in areas such as resource efficiency, decarbonization, and others. And so we've introduced tiered interest rates for the suppliers. So as I mentioned, the product starting point is that we leverage the balance sheet of very large buyers. So that immediately reduces the interest rate for the suppliers. We can further provide incentives as suppliers reach milestones. Now, these are milestones that we agree on with the buyers and the suppliers. It will be sector and sometimes even product specific. So, for example, in the sugar sector, the largest buyers of sugar globally many years ago agreed to a standard which is called Bon Sucro. So Bon Sucro allows and helps suppliers of sugar to reach full certification, which would allow them to produce much more sustainably grown and responsibly grown sugar. As the suppliers improve in these standards, and we set 4 different levels with Bon Sucro, the interest rates progressively go down. The interesting aspect of this product is it's ongoing. So every single export, every single shipment that a sugar supplier makes, they're going to know what their certification level is, and they will see the effect of that on the interest rate. And as margins are pressured, the suppliers will see those incentives, and it allows them to partner with their global buyers to reach their agreed milestones.
It's a fantastic example. Thank you. And John, I'd like to return to the report. The report notes, growing risks from sanctions, trade restrictions, and extreme weather, which we've talked about on the podcast already this season. How are these forces fragmenting global trade and altering the way commodity markets function?
That's a good question. And we have seen a lot of sanctions, trade restrictions, trade frictions, the responses and counter responses for the past year or so. In fact, for the past 4 or 5 years. So we're going through a period with a lot of issues, so to speak. Some are made by humans and some are natural consequence of nature. Now, on the trade front, what happens for most of the commodities, when there's a trade friction, there's a lot of pressure on prices in the short term. There's a downward pressure on one country on prices because there's not much demand, but there's upward pressure on another country where the demand comes from. So trade frictions produce a lot of dislocation, so to speak, in the short term. But what we have noticed from earlier experience is that those frictions, they do not last long in the sense that they last a few months, like 4 to 6 months. And after that, you have new trade kind of arrangements, and that prices go back to normal. But I have to highlight the fact that because of the new sort of trade structures, on average, prices are a little higher than what they have been prior to the trade friction. And that makes sense because the trade routes and the exports and imports are a bit less efficient than what they were prior to trade. So trade sort of issues affect a lot commodity markets, but they do not affect them in the long term. So to summarize, trade issues, trade restrictions have a large shorter impact. In the long term, not as much of an impact, but they do kind of put an upward pressure on global prices.
I'm thinking about just really how we've talked about resilience as a thread throughout the year and how much disruptions really highlight the need for resilience. And so, Farzin, I'm wondering if you could tell us more about how the IFC's really helping companies and governments strengthen supply chains and their financing structures to withstand the shocks and seize the opportunities in a increasingly more uncertain world.
So here, our role is to really partner with our clients and buyers and support them in the strategies which they've chosen to meet these issues and to make their suppliers more resilient. So there isn't really a one size for all fits all approach here. But the sustainability linked pricing that I mentioned is really key to this because it allows the buyers to shift their strategies as needed. So if they can, when we first started the program years ago, the focus was really on social standards. And that's still the case, but more and more the issues are decarbonization, removing risk from the supply chain, nearshoring, if that's what's required. So we bring in new suppliers into the program as needed as buyers start relationships with suppliers that may be closer to home or in markets where there's less geopolitical issues. Although these days that may be hard to forecast and it's a very changing scene. So I think the key approach for us is to be flexible and to have an ongoing conversation with our clients, both on the buying side and the supplier side, and to provide the financing and meet their financing needs.
All right, John, Farzin, thank you both so much for sharing your insights into the commodity markets outlook and how it provides valuable context for both how global trade dynamics are evolving, but also how the IFC plays a role in this. We really appreciate having both of you here today.
Thank you, Nicole, for having me into the program.
Thank you very much. It was a pleasure speaking with you.
We couldn't have been more grateful to have both of you for our final episode of the season. And I'm also super grateful to all of our listeners for joining us. Good news is that Beyond the Box will be back again in the new year, so please stay tuned.